Okay, this is a question which is for ACCA AFM, and we took this question from ACCA Study Hub. Okay, so that's a good source question. Um, Topic is risk management, and within risk management, it is about your currency exchange risk management. It's a short scenario, but it will give us opportunity to understand and learn three different concepts or three different challenging areas. One is the netting off and the tables, who is paying, who is receiving, how much of foreign currency coming in different, in different currencies like dollars, euros, and sterling. So sometimes students, they get confused when they see this type of table. So we will learn how to read it, how to understand it, how to interpret it. And then we will calculate our exposure. How much is our exposure of foreign exchange? And then we will hedge that exposure using either the forward contracts or the options. So we will learn this table, we will calculate exposure, we will use forward contract, and we will use options. So quite a lot of learning in a short scenario. Let's quickly read it. It's not very long. It says MJY Group. Assume that it's now 31st December. Dates are always important because we have to see the contracts for options, which dates are given. So it is 31st December. MJY company is a UK-based multinational company, which means that sterling is their home currency. It's a UK-based multinational that has subsidiaries in two foreign countries. Both subsidiaries trade with other group members, which means S1 will deal with S2 or with parent, and with four third-party companies. So there are four outside companies as well. And remember, the risk usually is with outsiders. Within the group, we can settle it very easily. So exposure comes from external sources, which are these four third-party companies, which are company one to company four. Okay. Projected trade transactions for 3 months' time are shown below. So this is a forecast of the transactions in the next 3 months, which means January, February, and March, because we are sitting on 31st of December, and this is the data for the next year, Jan, Feb, and March. Okay, got it. So MJY company, and then subsidiary 1, subsidiary 2, subsidiary 3. These are internal, this is external. Then MJY company, subsidiary 1, 2, 3, and subsidiary 1 and 2, and then 3, 4 companies. I'll come back to this table in a while. Let's first read some other information. So foreign exchange rates have been given to you for dollar to sterling and euro to sterling. Because you know that everything has to be converted to sterling because we have to protect the sterling. So dollars per sterling and euros per sterling, spot rates have been given to you. 3 months forward rates have been given to you. Then dollar sterling option, and the size of the option contract is 62,500 sterling. Premium is in cents per pound. So remember that premium, the option premium is not in pence. Option premium is in cents, which is a denomination of dollars per pound. I'll explain you how to calculate, how to convert, because this is also one problem sometimes students face, that if I have some premium, how to convert the premium, or do I need to convert the premium amount also into sterlings or not? And then we've got call options and put options. We have February contracts, May contracts. So either we are going to go for calls or we will go for a put or whatever. So we will also learn, should we be using February or May? Which one we are going to use? Then are we going to use call or are we going to use put? This is another question. You will get the answer. Or should we be using 1.8 or 1.78? This is another question, because when you see this table, usually what comes in that, okay, what I'm going to do, February or May. Okay, let's suppose we are going to go for May. So February we cancel out. Now we've got 2 Mays. One is under calls, one is under puts. So which one are we going to do, call or put? We will see this. This will depend on what do we have in our hands. And then another question will come, 1.8 or 1.78. Actually, we will make workings with both, because these are not, it's not something that you might be necessarily be using only one. These are the two possible offers you have. Okay, so strike rate this, strike price this, strike price this. So we will be using both of them, and then we usually make a comparison. Whichever suits us, we take that offer. So it's an offer, by money market. Money market says you want 1.8 strike rate, strike price 1.8, take 1.8, but you have to give this premium. But if you take 1.78 strike price, premium is less. So strike price is less, premium is also less. Anyways, we will come back and we will discuss this in detail. Now, what is the requirement? The requirement, it says that working from the perspective of a group treasurer, so you are talking about the group, so you have to protect the risks associated with the parent company, which is MGY, as well as subsidiaries S1 and S2. Devise a hedging strategy for the MJY group and calculate the expected outcomes of the hedges using forward contract, hedges using forward contracts, and for the dollar exposure only, currency options. So currency options also you have to do, but currency options you only do for the dollar exposure. So it means that for forward contract, I will see I have to hedge my dollar as well as my euro exposure. So I will have exposure in two currencies, and I have to hedge both of them. But in case of the options, the examiner makes your life easy, and he says that only the dollar exposure. So options calculation or options working, we will only do for the dollar. Yes, if for yourself you want to do it for euro, you can check it, do it for additional practice. But as far as for exam is concerned, forward contracts we will use for both currencies, options we will use only for one currency. So this is the scenario. Now, first thing, this table, starting with the table, because this is the beginning point, that how to read this table, how to understand the table. Now, what is happening, that you've got three companies in the group, the parent, subsidiary 1 and subsidiary 2. They are dealing with each other, and they are dealing with the outside companies as well. And they are receiving money from each other and from outsiders, and they are paying money to each other and to the outsiders. This is first thing. Now, three different currencies are given in this table. You can see a dollar, you can see a sterling, you can see a euro. So first thing, because you are a UK company, so any payments which you receive or which you make payment in sterling, those are not relevant to you, because sterling does not create an exposure to you because that's your local currency. So these numbers which are with sterlings, we actually are going to ignore them. Okay, so this is not something which is creating a risk for us. The risk is only coming from dollars and euros. Number one thing you understand. Then they tell you that you have receipts you read across, which mean in this way, and you have payments you read down in this way. Now, if I have to think about what are my receipts and receipts in the foreign currency. So I'll start with MJY Company. MJY Company is going to receive $90,000. Is it in millions or what? Yeah, it's in thousands. So it's $90,000 from company A. They are going to receive 60,000 sterling from company 2. We are not interested. But they also have to receive from company 3 75,000 euros. Then from subsidiary 1, they have to receive 40,000 sterling. We can ignore. This is the money which is coming from within the group, and we should actually consider it in the calculations as well. We should consider it in the calculation because in any case, it's a foreign currency. Then for subsidiary 1, you again will have your receipts. So subsidiary 1 is going to receive from company 1, then euros, then dollars, then from company 2, 4, and then it will have MJY companies and so on. So this way you are going to calculate how much receipts you have. By the way, you have to separate the receipts in dollars and euros separately. So let me just make some coloring. For example, if I'm considering, I will start solving the question in a while, and I will type in the calculations and numbers here, but just for a temporary understanding. This is dollar. This number should be considered as in my calculation. This will be considered. This will be considered. This will be considered. This will be considered. So these are my, this is the sum total of these numbers is going to be my dollar receipt. This is, we are not interested because we are not talking about company 1, 2, 3, 4. These are external. So I'm only talking about as a group, what I'm going to receive in dollars. So what I'm going to receive in dollar is 90, 40, 20, 30, and 50. Then what I'm going to pay in dollars, what I'm going to pay in dollars. So if I think about what I'm going to pay in dollars, let me select a different color. So now you will come down like this. Forget about this company 1, 2, 3, 4. This is because this is down, read down for payment, and I'm talking about dollars. So this is a dollar payment. This is a dollar payment under MJY. Under subsidiary 1, they don't have any dollar payment, and subsidiary 2, they do have they do have this payment to subsidiary 2. So you've got this 70, 170, 120, only 2 payments you have. This was already marked. Then you come back, how much you have to receive or pay in euros. So if I talk about receipts in euros, so euro receipt is this one. Then there is no euro receipt. Then I've got euro receipt. Then I've got a euro receipt. Then I've got a euro receipt. So I'll calculate my receipts in euros. So I have my dollar receipts and dollar payments separately to find out what is the net dollar amount. So you might be having, I don't know, $300,000 coming in, maybe $400,000 going out, and you say, I've got 100,000 of dollar exposure. I have to pay $100,000. Then you will make calculation for euros. You will say how much euros I'm going to receive and how much euros I have to pay. So if you think about how much euros you have to pay, you again come back like this, and there is no MJY company. They don't have to make any payment in euros. But yes, subsidiary 1, we've got a euro payment, we've got a euro payment, then we've got a euro payment like this. Okay, so first you need to identify. So there is no reason to be scared of this number. Anything which is related to company 1, 2, 3, I'm not really concerned. Their receipt and payment. I'm concerned the receipt and payments of MJY, the parent, subsidiary 1 and subsidiary 2. And I'm ignoring this sterlings, and I will only pick up, I have to separate these numbers. This is one big part. This is one important part, because the entire calculation later on will depend on this working. If you make a wrong calculation, or I mean, if you make a wrong number, so it means that you might be, if your exposure is wrong, of course, then your forward contract amounts will be wrong, then your option amount will be wrong. So you have to calculate the correct numbers as far as receipts and payments are concerned. So let's see like this. What I have to do, I'll say uh, receipts in USDs. This is first thing I need to make. Then I have to say payments in USD. Okay, this is the second line, and I would rather prefer to make it slightly bigger. Okay, so you can read it well. Okay, so we'll start picking up the receipts in USDs and the payments in USD and the net exposure of USD. Okay, so if I come back now again, receipts in USD. So receipts in USD are, let me circle them and then I can type them later on. Okay, it's better to circle them so that we don't get confused. So I've got a USD receipt of 90,000. Then I've got a USD receipt of, receipts are coming in this way. Okay, this 50,000. Then I have another USD receipt of 40,000. Then I have a USD receipt of 20,000. Then I have a USD receipt of 30,000. These are the only receipts in USD. Okay. So I just followed this pattern. For each company, find out what USD they are going to receive. So we'll type in here for USD receipts, and that is actually 90 plus 50 plus 40 plus 20 plus 30. Okay. And we make a total. That makes us 230,000. Then I can clear these numbers, and then I say how much the USD payments do we have. Okay. So USD payments, if I start thinking, payments are coming from top down, and I'm talking about MJY subsidiary and this one. Okay. So in this case, you should be doing in MJY, you have 170 receipt and you have 120 receipt. In subsidiary 1, they don't have any USD receipt, but subsidiary 2, they have this $50,000 receipt and nothing else. So it's pretty simple. Now, I'm sorry, I need to first type in and then I should remove. Okay, 170 plus 120 and plus 50. So that again comes here. Now, you can actually put that into negative number if you wish to, or you can just put a bracket and then so that, the, how to say, numbers, they make sense. So you've got 230 coming in, 340 going out. So now you know exactly that what you have USD net receipt. Let's call it like this. Although it's not receipt, but because I put it into negative, it means that you have to pay USDs. So what is happening? Your local currency is sterlings, and within 3 months' time, you actually need $110,000 to settle your, transactions. So your exposure to US dollar is $110,000, and you don't have excess dollars. You are actually short of dollars. So this is we did for dollars. Okay, let's call it USD. Now we need to do a similar working for euros as well. Okay, so I'll just copy paste it here, and receipts in euros. And I've got receipts, payments in euros and receipts in euros. Okay. So this number is very important. I mean, if you make a mistake in, you know, picking up something data from here, your entire question will be affected. I mean, because ultimately this is the number based on which we will do our further calculation. Now, if I start with euros, and again, first I will be talking about the receipt in euros. So MJY company, are they receiving any euros? Yes, they are. And the number is 75. No other euros. Subsidiary one is receiving euros. Uh, Again, euros. Again, euros. Subsidiary 2 is also receiving euros, and quite a lot of numbers. Quite a lot of numbers. Did I make any sterling? No, I didn't. So their receipts in euros are 75 plus 85 plus 40. No, not 40, sorry. See, I was going to make a mistake. 75, 85 plus 72 plus 20 plus 52 plus 35. I'll take them here. I put an equals to sign. That's 339 euros they are going to receive. Now, the same thing you need to do about the payments in euros. So payments in euros, I'll start from here. So what do they have? MJY company has to pay 72,000 euros. No else, nothing else. 35,000 euros, subsidiary one, 50,000 euros, subsidiary two, and 20,000 euros, subsidiary two, and 65,000 euros, subsidiary three. So 72 plus 35 plus 50 plus 20 plus 65. And I should be putting a bracket and I will multiply it with -1 so that when I take it here, it comes automatically. And now I make a total. So they've got 97,000 euros. So USD net receipts, I'll call them Euro net receipts. So this is, it might look simple. I'm not sure if it looks simple or not. But this is something, the crucial point. I mean, you need to come to these numbers correctly. So in terms of euros, you have extra euros. So you will, after 3 months' time, you will be having 97,000 euros with you. And then, of course, you don't need euros. You have to convert it into sterling. So you just cannot sit down now and wish or hope for the best. Maybe the dollar rates will go up and down, the euro rate to sterling can go up and down, and you want to protect your position because I am short of $110,000 and I have a surplus of 97,000 euros. Both of these things I do not need. I want to get rid of that and I want to cover my exposure in the foreign currency. What I should be doing, I should be going for some hedging technique to protect my position and know exactly how much what will happen. Now, if I come down now, the second part will start here of this question, in which we will be seeing that okay, we have to use because the question requires you to do the forward contract. So forward contract you need to do for both of them. Um, for euros and for USDs. But for options calculation, you will only protect this position. For options, they don't ask you to do for this one, only this one. And they also have not given the data for option for that. They have given you the data only for dollar to sterling. They have not given you data for euro to sterling options. Okay, if I speak about the forward contract first. So forward contract, I need to protect my position of 110,000 and 97,000. The first thing is that what you should be doing. Are you going for a buy contract or a sell contract? Although the rates are, you have to pick up the rates from here as well. This is dollar to sterling. This is euro to sterling. So I need to spot rate is 1.7982. Of course, the first thing is that I need 3 months forward because this is on 31st of December and these things are happening in the next 3 months. So I'm going to go for a 3 months forward contract from here and from here. Okay. So these numbers for this particular forward contract part, spot rate I don't need actually. Spot rate I will be needing when I will pay by premium. Then I will be talking about the spot rate. But so far for this thing, I need 1.7835 or 1.7861. So what is happening that you are going to have, you will say that by USD uh, to sterling. Now I don't have this symbol in my keyboard. I don't know the shortcut by 3 months dollar to sterling forward contract. Okay. This is what you need to do because why you are saying that buy the contract because you need dollars. Okay. You need dollars. By the way, in this particular scenario, they don't tell you what is, like here you have put or calls. So you need to decide this is buy, this is sell, this is buy, this is sell. Okay. So I'm going to buy the dollar sterling contract because I want to buy the dollars. And how do I buy the dollars? By giving away the sterlings because I have to make a payment in dollars. I'm short of dollars. So I'm buying the contract. Same time, I would say that sell euro sterling forward contract. Okay. So this is what I'm going to do next. So how much dollars do I have? I've got $110,000. And now the big question comes. If I'm talking about this thing, which number I should take? Okay. Um, which number should I be taking? 1.7835, 1.7861. Now, some of you people have done quite a lot of questions. Maybe their mind is clear. They know that which number should I be using. They can see this thing and they can find out. Sometimes some people, they are not really very much confident that should I be taking 1.7835 or 1.7861. So we go back to the very basic thing. The first concept we said that you should always choose a rate which is unfavorable for you. So imagine if I put here just to for the conceptual understanding, if I put 1.7835, this is one rate. The second rate which is given to me is 1.7861. And then you have, because dollar is a smaller quantity, it's a smaller currency. Sterling is a bigger one. So of course you will get less sterlings, or you have to pay less sterling to get $110,000. So you are going to divide it, not multiply. You have to divide it. So if I divide this number here and then I copy paste. So it is like for those people who do not understand, I'll explain the concept in a while, but if you don't have this understanding, you should see that how many sterlings you have to give to get 100, because you are going to buy sterling, buy dollars. So I need $110,000. So should I be giving 61,676 sterlings, or will I be giving 61,587 sterlings? That's the question. And we said that based on our common understanding that the other party will never give you a better rate. The worst rate is for you. The rate which makes you the worst off, that is for you, which means that they will be asking you to give you more, to give more sterlings. So this is your rate for you, 61,676, because this is very favorable. It's a favorable rate because with less sterlings, with 61,500 sterlings, you can buy 110,000. Here, with 61,600 sterlings, you need. So, of course, the bank will be asking more sterlings from you. So, this is not your rate. This is, I mean, if you are confused and you are not clear that which rate applies to me, you can always check both of the rates and then make a comparison. The one which is not in your favor, that is always your rate. Okay. So actually what I did, I divided them. So it comes out to be, here I'll put the value, 61,676 sterlings you need. If you make this contract, now what does this number tells me? This number tells me that if I, based on this information, if I go to the market and I try to protect my position that, oh, I have to pay $110,000 in 3 months' time, I can make a contract, and in 3 months' time, I can take out from my bank 61,000 sterlings and take $110,000 and settle my liabilities. So I have restricted my risk or restricted my dollar exposure into my local currency of 61,676. That's what it says. Now, if I come back and I said, okay, how do we, if we don't apply both of them, if you don't apply both of them, and can you just visually pick up straight without doing two multiplications and two calculations? It might be, how to say, um, spending more time. So can I directly understand, should I use this one or this one? Now, remember, now there are again two steps or two approaches. One approach is again the mathematical approach. This is 1.7835 and this is 1.7861. I know that this is 110,000 and I have to divide it with a number. I have to divide it with some number because dollars will give less sterlings because sterling is a stronger currency. So if you multiply 110,000 with 1.7, for example, if you say, oh, can I multiply it? My friend, you cannot, because if you multiply it, it will make 200,000. So you cannot get 200,000 sterlings out of $110,000. So you definitely are going to divide. So first thing is you have to divide. Now, second thing is which one with? The one which will give a bigger answer, because the bank will be asking more sterlings from you. So you have to divide it with a number which gives bigger outcome. So this is a smaller number, it gives a bigger outcome. This is a bigger number, it gives a smaller outcome. Whenever you have a denominator, for example, if I divide it with 2, I get 55,000. If I divide it with 3, I probably will get 40,000. So I have to divide it with a smaller number. This is a mathematical approach, not the financial approach, the mathematical approach, that in order to have a bigger number in sterling, I have to pick up the smaller number because I'm putting it in a denominator. Okay. This is one, the second mathematical approach. If you want to see the market approach, like if you go and see, these foreign exchange office where you convert your currencies, they give you two rates. So what is happening? Are they going to, they have these rates buying and selling, okay? So what are you doing? You are actually giving sterlings and getting dollars. So will they buy your sterling at a higher rate or a lower rate? Of course, they will buy your sterling at a lower rate. What you are doing, you say, I am going to go to the market and give sterlings. So how many sterlings do I need to give? So you are actually selling your sterlings, right? To get the dollars. So if you sell some to them, will they buy it expensive or will they buy it cheaper? Of course they will buy it cheaper. So seven. So this is like the market approach. Like I convert foreign currencies very frequently. It's like almost every week. I have to convert euros and dollars into the local currency. It's like for me, it's very common. Whenever I'm outside, it's very common. So I can understand it like this way, from like the street method, which I call. Okay, anyways, are you clear with this thing? Okay, then we come to the euro side. In euros, I have 97,000 euros. Now here the strategy will change. Now, you can actually calculate both of them the same way, like I did, or you can see this one. But remember, in case of sterlings, you are going to give sterlings and get the dollars, because sterling is something which is not with you. You are actually, remember, in this case, you were selling the sterling and you were buying the dollars. In this case, you are selling the euros and buying the sterlings. So it's opposite thing, because in this particular case you were buying USD, here you are selling euros. So when you are selling euros, if you understand the logic which I explained you for here, it is going to be the opposite of that. So which rate I'm going to take? 1.4390. So what I did, what I tried to do, I tried to explain you why did you pick up this one. So if you understand this logic and this was for buy, now because this is sell, it has to be this one, opposite one. And now if I just find out the number and I'll say 97,000 divided by 1439, and that is 67,000 something. Just this one. Okay, 67,000 sterlings I will receive. So this extra euros which I will have with me 97,000. I'm not sure in 3 months' time what will happen. Euros and sterling will go up or down. So I'm protecting my sterlings. I know that if I enter into this contract, and then after 3 months' time, I will go to the market, I will give 97,000 sterlings, and I will get my 67,000, 97,000 euros I will give, and I will get my 67,000 sterlings hard cash. Okay. So you are buying the dollars and you are selling the sterlings, and the rates you have to pick up. Now, picking up the rate is something which we discussed or learned in the very first lesson when we start doing exchange rate risk management. So this is something very basic. Although it was very basic, but I still tried to repeat somehow, so that for you, those of you who could not understand earlier, they should understand it now. Anything you want to ask until here, forward contracts, this is done. First requirement, I mean, you've got two parts to do. One was forward contract for and the outcome. Okay, for USD and euros. For options, we will do only one. Although the calculations will be slightly more, but we will do only one part, that would be dollar. Anything you want to ask until here, please ask me. Okay, now we need to start for options thing. And two, three things we need to learn or understand. So we are going to do option for USD exposure. So what is the objective of calculating options? Number one, we'll see that if I use forward contract, to protect this $110,000 of risk, I need 61,676 sterlings. This is the cost in sterling. This is your cost. So you have a liability of $110,000 in 3 months' time because you have a negative 110,000, right? So if you say, oh, I'm going to protect my this position through a forward contract, how much it is going to cost me in terms of sterling? Oh, that is 61,677, 61,676. And then we will make our calculations for this one and we will find out a number. Maybe that number comes out to be 65,000. If that number comes out to be 65,000, you say, oh, I'm not using options. Options are more expensive for me. I can go and I will make a forward contract. So you are actually making a choice by using these two methods. Or maybe it comes out to be 55,000. And then you say, oh, forget about forward contract. Options suit me more. So this is the objective of calculating the option number one. Number two, how do these options will work? Options will work as, for example, I know that one contract, let's suppose the one contract which, now I'm not solving the question because question solution I will explain in 5 minutes later. Let's first understand the concept, what is happening. I can go and I can buy one option contract, which is 62,500. So can I lock it here? I say, is my cost 62,500? So apparently it looks like I can go and I can get one contract at 62,500, okay, which will have a strike price of either 1.8 or 1.78. 1.8 or 1.78 means that this options contract can be settled or can give you how many dollars? 62,500. Let me say 62,500 into 1.8. I'm just doing some numbers with you, okay? So it will be converted into 112,500 if I choose this one, or 62,500 into 1.78 into 111,250. So that solves my problem. One option contract of this amount can give me either 112,500 or 111,250. In either case, I can settle my $110,000. So both of them can settle my this thing. So you say, oh, I can get an options contract and my cost is 62,500 sterling. But no, your cost is not 62,500 sterling. There are few other things are happening because you have to pay 62,500 plus you have to pay the option premium. You have to pay the option premium. So you did not consider that. So let's calculate the premium as well and put it on the top. But then what is happening that in any case, they are giving me more dollars. I don't need $112,000. I need only $110,000. So it means $2,500 I'm getting extra. If I get this contract on this particular date, I will have $2,500 extra in my pocket. What am I going to do with that? Of course, I don't need dollars. I have to convert it. And convert it into what? Convert it into sterling. And when I will convert it into sterling, am I converting it today? No, I'm going to convert it 3 months later. So I will be using 3-month forward rate to convert these extra sterlings into extra dollars into sterling's back, because this contract, when this contract will be exercised, i will go I will go to them and they will give me $112,500 in my hand. What do I do? I have to convert this $2,500 back into sterling. And which rate I will pick up, this one or this one? Now this time what is happening? I'm selling the sterlings. I'm actually buying the sterling from them. So if I buy something from them, I'm giving them dollars and say, give me sterlings. So I'm buying sterlings. Probably this rate will apply. So this I have to convert. In this case, I also will have extra 111,250. So this extra hedging you are doing. And as a result of extra hedging, you will have extra amount with you, which you will be converting. So therefore, apparently, logic is very straightforward. That what is my cost? Here, my cost is 61. What is my cost here? My cost is $62,500 contract with two possible strike prices, and of course with two possible premiums, which I will calculate. And one more thing, premium is given in dollars. So you have to convert this premium also into sterlings. So you will have to convert the premium into sterlings as well. We will do it together. No worries. But I'm just explaining you understand that which way we are going. So what we can do, $62,500 contract we can buy. But to buy that contract, I have to pay the premium. No problem. I will calculate for each one of them. And then at the end of the term, when this option will be exercised, I will have some surplus dollars with me. Those surplus dollars, I will be converting them into sterlings, and those will be subtracted from this cost, because 62,500 will not remain my cost because I will get extra sterling. So this cost will go down. So actually, with 62,500, you will add the premium, and then you will get some extra dollars as a change left from that transaction. That change you will convert into sterling and put in your pocket. So your total cost is expected to go down. So this is the scenario, okay? But again, one more thing before I do. Sometimes, not in this question, this is what I explained is exactly happening in this question, and we will solve it together to see the outcome. But sometimes in some other questions, what will happen, that probably you need $120,000. So contract is 62,500. So if I go for this one, it will give me only $112,500. This option will give me $111,500, but I need 120, imagine. So if I need 120, so what will happen? Now, in this particular case, because I need 110,000, so what you are doing overhedging. You are doing overhedging because, the contract cannot be modified. It is 62,500. It gives you 112. You need 110. So you have extra 2,500. It is called overhedging. You are doing overhedging. But imagine that you don't need 110, you need 120. So if I make one contract, it gives me 112. Can I make two contracts? Does not make sense, because two contracts will be $230,000. What will I do with $230,000? What I do, I make one contract with 62,500, which possibly will give me $112,500. This is sterling. And whatever is the difference, how much is the difference of exposure? The difference of exposure, you say, okay, I need to pay 120,000. Through this contract, I have secured 112,000 already. So I still have some exposure left of 7,500, because this contract will be converted to $112,500 only. I need $7,500 more. So what you do, you make one option contract, and this remaining thing, you will convert it into through a forward contract. You will say, I will use both of them. And this is what happens in many questions. And you have seen my lecture videos and question videos, you have noticed that we use one option contract to cover the major part. If something is left, that I will use a forward contract, 7,500. And forward contract, which rate? Today's rate or forward rate? Of course, forward rate. because this is not going to happen today. So forward rate. In forward rate, which one? This one or this one? What you are doing? Oh, I am selling the dollars. So in fact, you are buying sterlings, and buying sterling will be at the highest rate because nobody will sell you cheaper. You go to someone, say, I want to buy sterling. They say 1.7861. So this one you would be converting later on. So this is like I told you. Now this particular question is for over hedging because the contract amount is bigger. But if you have under hedging and you have some amount left over, that leftover amount you will use forward contract to protect it as such. Okay. By the way, let me tell you one more thing. Now, this is before I come to options calculations. Don't want to confuse you, but just want to make a picture in your mind clear. For this types of amounts, it's what it says $90,000 or $110,000. It's a very little amount. Nobody is going to use this option in real life because when you are using options, the entering into contracts and then monitoring and managing and supervising and exercising the options, it has a lot of administrative cost. So for small amounts, usually what is recommended, if somebody says, for example, it is 61,676 and option comes out to be 62,000, or maybe, okay, option is slightly cheaper. Imagine option is only 61,000. So this is little bit expensive, but we still go for that because that makes things easy. It's a straight, simple contract for such a small amount. Yeah, if it had been in millions and the difference is huge, then you make a difference. In this particular case, for 676 sterlings, 600 sterlings, you don't want to enter into this fuss of going into options. That's just, you know, a perspective what happens really. Anyways, we need to calculate how. Okay, now uh, first thing, what are the dates? The dates are February. You are sitting in December, on 31st of December. And this is the cash flow for 3 years, which means January, February, and March. So you are going to have this cash flows with you by the end of March. So it means that February is not relevant for us. February is gone. We are not thinking about February because the scheduled cash flow is 3 months forecast, which means end of March. May is relevant, number one. The second thing is within May, is it going to be a call option or is it going to be a put option? What are you doing? Are you going to buy or sell? So you say, I'm going to, because you have to pay 100 and you have to pay dollars, right? Pay in dollars. This is what is your requirement. You are short of $110,000 and you need to pay $110,000. So one way of seeing it is, oh, I want to buy dollars. This is one way of seeing it, which is not correct, actually. Your home currency is sterling. So you don't say that I want to buy dollars. Say I want to sell sterlings. This is what you have. The contract, you are going to have a put contract, which means a contract to sell sterlings. So you are not talking about calls because this contract is in sterling. Are you going, call means buy something, put means sell something. Are you going to buy sterlings or are you going to sell sterlings? So, because if you buy sterling, you say call sterling, which means that you are going to buy sterlings, and to buy sterlings is not the objective. I mean, objective is to sell sterlings and get dollars. So this is your contract, put contract. Okay. Always remember, because this is one crucial decision, and sometimes students they get stuck. Am I going to use calls or puts? So basically, you need dollars. But how are you going to get dollars? By selling the sterlings, what you have. What do you have with you in your bank account? Oh, I've got sterlings. So go and sell your sterlings. And the contract is in sterling, sterling to dollars. So if I'm selling sterling, what do I get? I get dollars. This is not a euro sterling contract. This is a dollar sterling contract. So if I sell sterling contract, what do they give me? They give me dollars. Oh, that's what I need. So you need to have a put contract, and you need to have a put contract for May. So calls is gone and February is gone. So these are the numbers. 5.34 is my premium, 4.20 is my premium. And these are the two strike prices. You don't have to say that only one of them is for you. Actually, both of them are for you. The bank says, I give you two options. I can convert your dollars, your sterlings into dollars at the rate of 1.80. No problem. Come to me and you can sell 62,500 sterlings at this rate, or you can convert them at that rate. Because here the rate is effective, the rate is even better. So he's asking for a bigger premium. Here, the rate is not really very well. It's very close to this thing, and he's giving you 4.20 premium. So these are the two premiums which are related. So we can start with this like this. I'm not sure if the table, how do I make the table? I'll keep on thinking maybe I will change the table as I do my workings. So first of all, I just say strike rate price. What is the strike price? We have to do calculation. Why it is so small? It is coming here. Oof, oof, oof. Make it bigger. Okay. Strike price. Okay. So strike price could be 1.80 and 1.78. These are the two strike prices for which we will make our calculations. If I have strike price, so 1.80 receipt in USD. How much will be the receipt in USD? 62,500 into this one and this one. By the way, you have to explain this thing in before you start doing the calculation. In exam, you cannot just come and say, oh, let's start make the table. You have to explain that since the data is given on 31st of December and it is a 3 months forecast. This means that the expected cash flow will be, the cash flow is expected at the end of the 3 months, which is March, and February options have already expired, and therefore we should be choosing the May options. Okay, number one. Second, you should say that because we are short of dollars, so we need to buy dollars by selling the sterlings, and therefore we need to get a sterling put contract. A put contract we need, and a put contract with each contract having a value of 62,500. So, I mean, you need to, tell examiner what you are doing. It's important. I mean, you just cannot put the numbers straight away. You probably will get marks, but less marks. So it's important that you make a write up here, 3, 4, 5 lines by explaining what you are going to do. Okay. Then you have here receipt in USD. You see, you are getting extra dollars. You don't need this much of dollars. We will show it later on what to do with that. But you have to pay the premium. Right away, you pay premium. And remember, the premium comes out in dollars. Premium is given, and it is actually in most of the questions, premium will be in dollars. And it says here also specifically, it says that premium is in cents per pound. So how many cents do you see here? It says 5.34. So I need to convert it into cents, 5.34, and I'll convert it, divide it with 100 and multiply it with 62,500. So this is 33375. How do I do this calculation? 5.34 divided by 100 multiplied by 62,500. So this is the premium. Okay, let me put equals to sign. And this premium comes out to be in dollars. Here it will be 4.20 divided by 100. So what I'm doing, I'm converting it into dollars and then multiplying it with 62,500. So 2625, and this premium comes up. Okay. And this premium is in dollars. And I have to convert this thing into sterlings as well. So if I convert my premium in sterling, okay, premium in sterling. Let's call it GBP. Let me make it short. Okay, how much it will be? Premium in GBP. So I just did the wrap text thing. I'll wrap this one as well so that the table does not bothers me. Okay, I'll make wrap texting of this as well. Okay, anyways. Now I have to convert this premium into GBP. And which rate? So here I will be needing my rates, spot rates, and this one. So I have to convert the dollars into sterlings. And remember, this will be done on the spot rate because you are making the option contract today, not after 3 months. So which one are you going to take? This one you are going to take, 1.7982. This will be the rate at which I will convert, divided by 1.7982. And this divided by 1.7982. Now, what is happening? What are these numbers? What are these for? See, I have to buy the contract at $62,500, which is my basic cost, plus I have to pay the premium. Plus I have to pay the premium. So this is going to be added. Like I explained to you in the beginning, 62,500 plus the premium. And of course, 62,500 in sterlings, I cannot add this 33 because this is in dollars. I have to convert it into premium, and premium will be converted at the spot rate. And you might be thinking, I'm not sure. If you are, why did we use 1.7982 and not 1.80? Same logic. What do you have? You have to pay the premium. And how are you going to pay the premium? By buying the dollars and by selling the sterlings. So you are selling sterling to pay the premium. So if you are selling sterling, he is not going to give you more rate. He is going to give you a lower rate for sterling. So that's why I use 1.7982. Then what is the next thing? You have extra dollars with you. Extra dollars. Extra USD. How many extra USD you will get? Remember, you need only 110,000. So I've got some extra dollars because I convert them at 1.8. They give me 112,000. I don't need it. I need 110 and I get extra USD. Now this extra USD again I don't need. So I convert it extra USD to GBP. This USD also I convert to GBP so that because this is something a change left over from the transaction. And this I need to convert. And if I am converting this thing, USD, this time what I'm doing, I'm going to sell this or convert this USD, and I will use the 3 months rate because this thing will happen after 3 months. So here I'm taking the 3 months rate. And in 3 months rate, I will take this one. Remember, in the premium, I took this rate because premium is happening today and I am actually selling, how to say, the sterlings and getting the dollars. So 1.7982. But 3 months later, I will have dollars with me. And I say, oh, I want to buy sterlings. I have $2,500 with me. I say, you know what? Take my dollars. I want to buy sterlings. So if they are selling me sterlings, will they sell me at a lower price? Of course not. They will sell me sterling at a higher price. So 1.78617 will apply. So what I'm going to do, I will apply here 2,500 divided by 1.7861. So 1339 or whatever. This is how it will be converted. This is my benefit. Now you can actually mention here that which rate you are using, 1.7982. Here I used 1.7861. Now you can say, okay, if the strike price, okay, for strike price 1.8 and for strike price 1.78, these two strike price, what is the outcome? Outcome is I have to pay, okay, let me just mark the numbers. I need premium in GBP, this number I'm going to make, and this number I'm going to see, okay, 1399 or whatever it is. So I will have 62,500, the amount of the contract which I will buy, plus I have to give premium 1856, minus I will get back those extra dollars 1399.7, let's call it 1400, so that we don't go into decimals. So if I take it here, it comes out to be how many sterlings? 62,956 sterlings you have. Your cost of protecting $110,000 is 62,956 sterlings. In this case, it will be 62,500 plus the premium, which is 1460, minus the dollars which you get back 699, I'll call it 700, so that I don't have to go into the decimals, okay? And I put it like this. And here it is 63. Now you need to actually compare which one is better for you. I'm talking about US dollars only, not the euros. I've got a forward contract with this one. Options, I have two offers, 1.8, 1.78. One is 62,956, one is 63,260. Now, of course, forward contract is easy to maintain and it is also cheaper. So you are actually going for a forward contract. You're actually going for a forward contract. Okay. This is the end of this question. Because with the strike price of 1.8, 1.78, these are the outcomes. In reality, now question is solved. Now, if you have to conclude, you can say that forward contract is easy to administer. Its cost is also less, and therefore this company, MYJ company, should go for a forward contract. And the cost of protecting, the cost of hedging $110,000 in 3 months' time under the market condition, under the forward contract is 61,676 sterlings. And by the way, what is your effective rate? If somebody says, what is your effective rate? You are getting it. So effective rate is 1.7835, whatever. In this case, what is your effective rate? You can convert 62,956 effective rate from here. I can say how much actually it is costing me. 62,956. And if I 110,000 I have, so 110,000 divided by 62,956, 110,000 divided by 62,956, that is 1.74 or something. A different rate is coming. Now, if you go back to what happens with bigger volume contracts, sometimes you have to protect not $110,000, probably you are talking about $25 million, $10 million, $5 million. And the answer comes similar. Like forward contract, it looks little attractive, but this is an option. What do you do? Still, are you going to go there? No. If you are, because options, they do have a potential benefit. A potential benefit. There is a potential of making more money with an option. That's why we call it option. Forward contract is a strict contract. It will be executed, not $1 more, not $1 less. There is no hidden potential here. There is no opportunity to make more money out of here. This is done. This is the written contract. In options, what is possible? And you actually can also give this explanation as well, part of the question, that when you enter, although for a smaller amount, it looks simple, but in reality, what happens that imagine that the dollar moves in a very favorable way. The dollar becomes weaker. Right now, you are saying, oh, I have a strike price of 1.8, which means one sterling, I can buy, with one sterling, I can buy $1.8. What if the market moves the other way and the dollar becomes 2? Then you might be thinking, this is an option contract, I will lapse. I will not convert it. I have a strike price, but that's not my obligation. That's why I call it option. I will not convert it to $112. I will actually convert it into, I will have more dollars with me. I can buy dollars from the open market, and my only loss will be premium. Maybe dollar becomes very cheap. One sterling, $1 becomes, I don't know, 2 sterling. One sterling becomes $2, and then in the market I can go and buy $110,000 with two, with only 55,000 sterlings. And the only loss with me will be the premium. Imagine if I tell you that, okay, you have got this thing. What happens in the market if the rate becomes sterling to dollar is 2? Then what will happen? You will say, I'm not going to take the strike price. It's an option. I'm not going to convert it into 112,000. I will take my 55,000. I will buy these dollars from the market. How many I need? 110 divided with 2. I will make 55,000 sterlings as the cost to pay $110,000 plus this premium, which I already have paid. So 1856. So I might end up with 56,856 instead of 61. So in options, you have this opportunity that if they move in some opposite direction, in a favorable direction, you can lapse the contract and then you can buy the dollars. You can just, tear it apart, throw it away, and you say, options I'm not exercising. I will buy dollars I need. Dollars are very cheap in the open market. I can go and buy from the market. Premium I already have paid. That's my sunk cost. It's gone. And then you don't have these extra things or so on. But this will happen if the market moves in some unexpected way. Now, because your volume is so big, you are talking about $10 million. And if market only moves 2%, 1% the other way, you have this type of benefit. But because it's a smaller contract, so even if the market moves, it will never become so profitable. So it's a smaller contract. But for larger contracts, we go for options because we bet on that potential. And by the way, this is also possible in exam questions as well. Sometimes they say that it is expected that dollar will become weak. If you read the questions, they say it is expected that dollar can become weak. So now you know that dollar is expected to become weak. Sometimes they say they are not sure if the dollar can become weak or not, and they say it can move 10% up or 5% down, 5% up. You have read such type of questions as well. So it depends on the scenario. What are your expectations? If they say that dollar is expected to become weak, I'll go for an option. So, I mean, I'll just giving you some otherwise understanding of these options thing. Okay. Any question you want to ask until here, please?